AI may capture the headlines, but distributions, or the lack thereof, remain the primary concern for investors who are still waiting for the windfall of exits that have yet to arrive. Of course, any discussion around distributions needs to start with looking at private markets' net asset value, the source for that potential liquidity. Private markets are pretty much growing everywhere you look. Capital is being put to work, and existing portfolios are appreciating in value. Unfortunately, the growth you're seeing in private equity and real assets isn't just because these investments are performing well. A major factor is that cash simply isn't being returned to investors fast enough. In 2025, absolute levels of liquidity were robust. However, in a growing asset class, the rate of distributions, while modestly up, remained below the long-term average of roughly 20%. This represents the fourth consecutive year of sluggish distribution activity for private equity and 3 straight for real assets. Meanwhile, credit is the clear standout, returning capital at or above the historical average. Drilling into private equity specifically, in recent years, SMID buyout consistently generated superior liquidity relative to other PE strategies. In part, this is driven by better exit optionality, including the ability to sell into larger cap sponsors and less reliance on the IPO channel. Benefits of the strategy you've heard us highlight previously. You've seen this table before. Over the past 5 years, credit and natural resources have been the strongest drivers of distributions. Unfortunately, that offers little relief for your private equity portfolio. The modest uptick in 2025 distributions has shortened years to liquidate across both private equity and credit. Whether 2026 finally delivers the liquidity wave investors have been waiting for is possible, but after the last 4 years and given the macro backdrop, expectations should remain measured.